Hi, everyone. Thanks for joining me. It's Jennifer Kirschenbaum coming to you again for an update during our COVID lockdown. I'm excited to bring to you my dear friend and someone I turn to for advice because of his knowledge base, Dom Nicolia from Regal Healthcare Capital Partners. I work with Regal on many of their portfolio companies and as counsel, and it's really interesting to get their perspective from an economic standpoint on just so many different matters. And during a time right now where there's so much uncertainty, I thought it would be really awesome to have Dom come in and just give us an overview. And before I turn it over to him, just so everybody knows what Regal is, and he'll tell you a little bit more about the platform of investing, but my relationship with them goes back a long time. Dr. David Kim, who many of us know in the community as one of the co-founders of CityMD, the owner of Premier Care, the urgent care facility that many of us live near, that is now CityMD, is one of the co-founders of Regal Healthcare Capital Management. And Dr. Kim, who is just an incredible, amazing human being, went from being a medical doctor, an owner, a founder, and then got his MBA at Columbia, and now has a private equity firm that invests in physician-focused, physician-managed healthcare. And he's really just leading the charge for us in society to maintain physician integrity. And I couldn't be just happier to work with him on these projects. So with that bit of an intro, I asked Dr. Kim if I could mention his basketball prowess, Dom, and he said that I could let everyone know that basketball is his main sport, which he's doing better at than his golf game these days.
Yeah, of course. Yeah, he's getting pretty good at golf, I think.
So with that, I'm going to turn it over to you, and hopefully you could just maybe give a little background on what PE actually is. I think there's a lot of mystery and fear in the physician community when they hear those two letters together. So just to start, it might be just kind of like, what do you do? And then if you could kind of talk us through some of the anxiety we have on the market right now and lending and stuff, I think that would be just a huge benefit for the physicians that I work with.
Sure, of course. Well, appreciate you inviting me to speak with you today, Jen, and to speak with the physician clients you have. You did a great overview of Regal, so I can't add much to that. But in short, I think private equity, oftentimes, nobody really knows what you mean when you say private equity. It's actually really simple when you really get down to it, right? Simply put, private equity is a pool of committed investable capital from a number of individual investors with the purpose of buying equity ownership positions in companies that fit a predetermined investment thesis. So in Regal's case, we have two separate private equity funds backed by about 80 individual investors, most of whom are physicians in the New York area. And they've committed over the course of 5 to 10 years, they've given us 5 to 10 years to invest $250 million of committed capital across those two funds. And we are permitted to invest that capital across any business that meets our investment thesis, which is multi-site and physician-led healthcare businesses. Generally, we're looking at smaller businesses in the $2 to $7 million of annual profit, or EBITDA, as you may have heard, range. And we're generally looking to invest the $20 to $30 million into each company with the opportunity to go more. I think private equity can be known to do majority investments or minority investments. Regal, we are control investors, but we like to think of ourselves more as partners, right? We don't look to buy 95% of your company and take it over. We look to buy 51% of your company and run it with you, using the expertise that we have from Dr. Kim's experiences and John Santem, our other partners' experiences, and then my own experiences and the rest of the team's experience. So that's private equity and Regal in a nutshell. I think, Jen, to your second question around the current anxiety that we're seeing in the market, I think there's no other way to put it. It's been a crazy time these last few weeks, especially for anyone who's practicing or who's invested in a healthcare practice in the New York area. I think given that New York is the hot spot or one of the hot spots, the impact's been exacerbated, right? Healthcare practices across the country have been impacted and are largely closed. But I think what we're seeing is in New York, that happened about 2 weeks earlier, right? And I think it's weird because we all know that COVID-19 is a temporary thing, but we just don't know how temporary it is, right? How long it can last. I think some of the more conservative, talking heads on TV will say it's going to take 18 months for this to finally clear, but who knows, right? And I think the question for us is how long until we can start getting back to normal? Look, the sad reality is that, although this is a temporary thing, many businesses and healthcare practices included within that won't be able to come back from this due to a lack of liquidity and inability to access new funds, right? I think no matter how healthy your business is or your practice is, no company is prepared to go 6 months with no revenue, right? So I think the way that we've been approaching it across our portfolio of investments, and I guess maybe to be clear, we own 7 different healthcare practices around the country in various areas, right? Dental, dermatology, fertility, psychology, autism, just to name a few, emergency room management. So I think for us, the way we're approaching it is we are assuming that this will go on for months, not weeks. I think optimistically we hope it goes on for weeks, but we're assuming it's going on for months. And unfortunately, we have had to make tough decisions. And I think any healthcare practice has to make tough decisions as soon as possible. So these are things like, adjusting your cost structure, right? So that means laying off or furloughing all non-essential employees, or switching all providers or associates to a straight percent of production compensation model instead of a guaranteed minimum, right? Reach out to all your lenders to get relief on debt service. Work with someone like Jen to contact your landlords and get rent deferrals or abatements. Turn off all discretionary spending at your practice and proactively reach out to all vendors and credit card providers. And then last, I think, which everyone sees in the news, apply to any and every government stimulus program, even if you might not qualify. Just apply, right? Make sure you disclose everything, but apply. And the way you have to look at it is let the government foot the bill on this one right now. So I think, Jen, I hope that answers your question of sort of how we're thinking about the market. I think with practices who take these aggressive steps, they should hopefully be able to come back stronger. And, for practices who are still a little more optimistic, it's going to be a little harder because, frankly, when we come back in whenever it is over the summer and the fall, it's going to be like starting a practice from scratch. You're going to have to invest all that capital again. You're going to have to build up your working capital. You're going to have to build up your accounts receivable. You're going to have to front a lot of cash. And for a lot of people, that's going to be difficult, right? They're just not prepared to do that.
What do you think? Because this is really where your insight for me is basically gospel. What do you think is going to be going on with lending for commercial lenders? Like for those of us who have lines of credit or even a refining like a personal mortgage, or what do you think this looks like the next couple of months?
Sure. So I think it's hard to tell. I'd say there's 2 different classes of lenders that we deal with on the private equity side, right? There is the traditional commercial banks, but then there's the more, call it creative finance companies, right? The ones who generally finance big private equity leverage buyouts, those types of things. What we're seeing is those creative finance companies, they're largely closed for business right now. Now, there's obviously exceptions, but they're running into the same pressures as we are because they also have debt on their own debt, right? So I think what that leaves is if you're looking for debt in the near future, absent government loans, you're going to have to go to a commercial bank. And I think optimistically, we're hoping that the commercial banks don't close down. I think they, in general, they got a bad rep during the 2008, 2009 recession of closing down, foreclosing on people, and just generally being bad actors. So we're hopeful that the commercial banks are going to be really cooperative here, knowing that, there was no sort of underlying issue in the economy that caused this, right? And the banks were generally strong coming into this. With that said, I think we're preparing our companies for the reality that no matter how healthy your practice is, you may not be able to get a loan, right? It's possible the banks remain open with air quotes, but they set the standard so high that only the best of the best will actually be eligible for loans. So to do that, we're sort of treating every dollar we have and every dollar of discretionary spend, we're treating it as gold, right? It's money that we may need in the coming months. We're of course going to try to get commercial debt, try to get credit lines, but it's going to be difficult. Now, I think where there might be a little bit of a difference between an independent healthcare practice and a private equity fund is in healthcare practice, you can put a personal guarantee on a loan, right? You may not want to, but you can do that. And, as you know, Jen, some and many healthcare practitioners have, significant net worth to back that loan. So that's the case. And if the provider is comfortable doing that, then there might still be an avenue to get a loan with a personal guarantee. In private equity, unfortunately, we're not able to do that just because there is no one person behind our fund.
So that's really insightful, Dom. I think that's great. I think there's one more area that we should touch upon before I let you go that I think is important. Before COVID, PE, I think, was actually the main generator of a new market for practices on sale, actually. Not in the dental realm, which, there's definitely some of our dentists that are on here listening. But for the medical, Pro Health was given $1 to lease your practice. Northwell completely decimated the concept of selling and actually receiving any money. But PE coming in, people were starting to think like, okay, my life's work, what I've built, I can actually maybe sell this thing for a multiple of my EBITDA, which for those of us who don't speak, PE is essentially your profit. And so there was a marketplace building again. What do you think is going to happen to that?
Yeah, look, I think private equity is not going away. Given where the economy was these last few years, private equity fundraising, so what we call dry powder, so money that's been committed to us that we legally have to invest and have not yet invested, is in the trillions of dollars. Regal ourselves, we have over $120 million of investable capital that we can call at a moment's notice to invest. So private equity is not going away. I think what is going to go away are some of these crazy stratospheric valuations that you're seeing, or maybe some practices getting more than they are really worth, right? And the reason that's been happening is in recent years, private equity has been in such a rush to spend all of their money because they have to spend all their existing money before they can go out and raise more money, right? And I think because of that, there's been so much competition for the healthcare practices because healthcare is seen as a defensible investment. That private equity funds have started to pay more and more and more. I think what you're going to see here is there's a lot of funds with investments that have gone sideways because of coronavirus or COVID, and there's also a lot of funds who say, you know what, I'm going back to, I'm just going to take a break. I'm going to take a breather for a year or 6 months and just deal with my current investments. So because of that, I think there's going to be less competition for assets, and that's going to drive valuations down, unfortunately for the physicians. So I think, though, what you're also going to see is you're going to see funds are going to come out of this and be able to, look in the rearview mirror and say, okay, which of our investments worked and which didn't. And what we're seeing across our portfolio are the businesses that were fundamentally sound and that they were selling you a good business model with historical growth, and they were selling with a selling physician who was really looking to grow. Those practices came through or are coming through COVID better than the ones who maybe there was a little bit more of on the come growth, for lack of a better term. So I think what you're going to see is private equity funds refocusing and really just trying to find the best in class practices and pay up for those and make those the so-called platform, while have the other practices you just have them as secondary and have them join the platform once you have that set. But I think, Jen, there's the flip of the coin. I think for physician practices, which you alluded to, is always thinking of private equity as the sort of this is my exit plan, right? This is how I'm finally going to realize all the blood, sweat, and tears I put into my practice. I think everybody, every physician, every owner, every provider really needs to take a long look in the mirror after COVID passes, right? And I think different practices are going to come through this in different states of health. But I think everybody really needs to evaluate what their options are. Even physicians who said never in a million years would I sell to a Northwell, or never in a million years would I sell to private equity. Everybody needs to look at those opportunities and say, look, something like COVID could happen again, and what's my safety net next time, right? There may not be all these different levers to pull next time. So you should, and it behooves you to examine your opportunities. You say, should I join a big hospital system? Should I join a big group, private equity backed or not? Or should I, if my practice is big enough, should I go to a private equity fund and become their platform, right? And have the funding behind me so that next time this comes around, my practice doesn't have to close. Right. So I think everyone needs to think about that and obviously make their own decision. But, it's something that we have those conversations with practices every day for the last, few weeks of, practices. They look and they see our practices, although hurting very much, are still open, still seeing patients. And they look at us and say, hey, how can I join you? Right? How can I join your dermatology practice? How can I join your dental practice? I want to still be out there and not worry about keeping the lights on. I just want to be out there helping patients. So it's something that, everybody really needs to think about.
Yeah, I think that just to piggyback on that, I think that a lot of times my clients don't really understand what that means to them, what that conversation means to them. And to me, it means starting to think about that conversation is think about their internal organization, any hierarchy, kind of the rainy day projects that they don't want to deal with, compliance, their contract structures, their vendor relationships, just kind of getting their whole house in order to figure out, what's the next step going to be. And most providers, they just don't have the time to deal with that during their day-to-day practice. And I think that I'm hoping that many of my clients are going to use this somewhat downtime. Most of them are partially, at least partially, if not totally closed, to kind of do that internal self-reflection process.
Sure.
And just so they understand also for PE, I want to make clarification. Guys, Dom is not saying that they own the medical practices. This is always an administrative services construct. And so what the PE shop does is they come in and they basically run the back office, not the medical end of it. And they offer internal support and structure, basically, is what we're talking about.
Right.
That's what Northwell does too. It's a management system.
Yeah, that's right. So, yep, that's right. Our goal is to, let the doctors do the doctoring. And, if you're a doctor on the front lines, right, you shouldn't have to worry about, negotiating contracts with vendors, or you shouldn't have to worry about just sales and marketing or the finance, closing the books, or, doing an audit, or, dealing with the legal stuff, right? We do that, and we sort of use our experience to help the doctors deliver care in the most efficient way possible. But at the same time, although we're run by a doctor, we do not, run the practice, and that's not our purview. So, that's good clarification, Jeff.
This is super helpful, Don. So I'm gonna get this out there to our clients and our newsletter. And if people do have additional questions that warrant further discussion, I'm sure we can reconvene. I know you, just like me, we're happy to be helping during this time. And hopefully this will help clarify a few things for some of the people listening.
Yep, of course. Well, Jen, thank you for having me. And I really appreciate it. And hopefully you're staying safe in this crazy time.
Thank you, Dom. Enjoy that little girl at home.
I will. Thanks, Jeff. Bye now.
All right. Bye.